This episode of Bulletproof Cash Flow is brought to you by Realty Dynamics. Learn how people like you can build substantial passive income while creating wealth for the long term through real estate investing. Visit rdyne.com. That's RDYNE.com.
Not only do you have to have hands-on management, but when it comes to especially, well, at any time, but particularly during times of distress, you've got to be really, really hands-on with your due diligence. Otherwise, you can make terrible mistakes. But you can, if you are good at what you're doing and you are thorough, the opportunities to buy at significant discounts are real.
Working because you want to, not because you have to, is financial freedom. And we want to help you create that. Welcome to the Bulletproof Cash Flow Show. We're going to teach you how to achieve lifetime financial freedom through real estate investment. Your host is a multifamily syndicator and property developer. He's done deals reaching into the hundreds of millions of dollars. You'll hear from experts in all aspects of real estate investment, finance, development, and management. Everything you need is right here. This is the Bulletproof Cash Flow Show. And this is your host, Augustino Pintus.
Quick question. How'd you find this show? Maybe a tweet or an Instagram post? Well, no ads here. Just a small favor to ask. If someone introduced you to this podcast, pass it on. Share, review, tell a friend. It means the world to me. Thanks a ton. Hey everyone, it's Augustino. Many expect distressed assets to be the center of attention in the next 12 to 18 months. Now that said, raising capital for or investing in distressed deals presents an opportunity for investors and sellers alike. Now our next guest knows all about this. He is a 30-plus year real estate veteran with finance experience who built a digital marketing system for real estate professionals who want to raise capital or crowdfunding, as he's taught over 4,500 people how to build wealth and preserve capital and of course, earn passive income from real estate in general, right? Now he's done over $7 billion of experience transacting in distressed real estate assets for major institutions and banks. Now here's the founder of Gower Crowd with over $1.5 billion of commercial real estate investing, and today helps real estate sponsors raise capital from high net worth investors. Now with all that, I'd like to welcome Adam Gower to the show. Adam, buddy, thanks for coming on, man.
I'm so happy to be here. Thanks for having me, Agostino.
You bet. Now, if you guys like Adam SSA, you can reach him via the contact page at gowercrowd.com. Okay, Adam, go ahead and tell us about your journey.
All right, thanks. And again, really appreciate you having me on the show. So look, today's show is exclusively really about distress. We're going to talk about distressed real estate. So I'm going to go ahead and focus on distressed real estate and that aspect of my career. So I started in commercial real estate in Southern California in the early 1980s. And I started actually by pulling wires for an electrician. And then very quickly after I was sick of getting my hands actually dirty on job sites, I started raising capital for a ground up multifamily sponsor. And as we chatted about earlier and is very relevant today, in the early 80s, it is interest rates, hard to imagine, but interest rates, mortgages were in the high teens. Let me say that again, high teens, low 20s. You got a mortgage for your house, they'd quote you 18, 19, 20%. Can you imagine that?
Yeah.
And on deposit at the bank, I remember I was getting 12% on deposit at the bank. Unbelievable. So, but that's the way it was. And the economy ticked along quite nicely. People made money. We did ground up deals. People invested in those deals. It was the normal state of affairs. Now, what's going to happen from this market that we're in now, going from near zero all the way up to 7-8% as we're going, there's going to be a flushing out of the market before we reach any kind of sense of stability. But that's something we can talk about later. Once then there was what happened was there was a crisis in what became known as the savings and loan crisis, where all these savings and loans, which were primary lenders to commercial real estate, many of them failed. And that wiped out the commercial real estate, and developers and investors lost money. It was devastating for real estate. This is in the late 80s, early 90s. So I tootled off to Japan, and I started working for Universal Studios. I was head of a division of Universal Studios, doing all of their real estate development in Asia Pacific. So that was all institutional capital. It was really interesting learning experience, on the institutional side. Then I came back and did my own developments. And in 2007, I had the dumb luck to sell all of my portfolio. And I was brought in, so that's right before the global financial crisis. And I was brought into a major bank to help them clean their balance sheet of non-performing commercial real estate collateralized loans. So that's where we left off. FYI. So what was interesting about that, Agostino, is that I saw so my job was to sell non-performing loans one at a time, collateralized by real estate, and to do some workouts. So I saw every possible asset class that there is in commercial real estate across the country, and how deals can go wrong. It's mind-blowing, actually, how deals can go wrong. I mean, I've got some crazy anecdotes I can tell you as well. We've not got enough time for all of them, but basically I got exposed to distressed real estate on steroids during that time, working for a bank. And then I went over to Colony Capital, where I was working on a $7 billion portfolio. It was a series of smaller portfolios of non-performing loans that Colony had purchased in partnership with the FDIC. So I saw a different perspective of distressed real estate at that time.
Yes.
So that's basically my background, but let me come to where we are today. So after the market started picking up again after the global financial crisis, so around 2011, 12 or so, and it was starting to pick up and values were coming back, I started to do seed investing, angel investing, it's like venture capital. And I was being pitched by all these young kids on their new businesses. And it didn't really matter what the business was that they were in. They were all talking about how they were going to do marketing. And the marketing they were doing was all online. It was digital marketing and completely foreign language to me. I had no idea what anything was. Automated emails. Wow, that was amazing. The idea that you could set in place. I mean, it was a not revolution. What's the term? It was a revelation.
Revelation, yes.
This was how business could be conducted, because you could never do this in commercial real estate before the Jobs Act of 2012. Mm-hmm. So the short story, and you can tell I'm not very good at short stories, but the punchline to this long short story is that I started to apply digital marketing tactics and techniques, best of class, to real estate capital formation to help sponsors raise money online. In other words, to help sponsors crowdfund their deals. So that's the long short story in answer to your simple question.
Beautiful. Love it. Love it. Love it. So distressed deals. Let's talk about distress. Like how would you classify a distressed deal if you saw one today? Like what would you say? How would you, but for someone who's not familiar with distressed, what is a distressed commercial real estate asset?
Okay, so it's a really good question. So I try not to say in my opinion, but I'm going to anyway. In my opinion, there is no such thing as distressed real estate. Now, with one proviso, and that is that there actually is. In some cases, if you find toxic waste on a piece of real estate, that's really distressed real estate, even though there are those people who will look at that and rub their hands with glee and think, ooh, opportunity, right? But for most of us, toxic waste like, gasoline or a someone that had a gas station on it, or a dry cleaners, where you go down into the ground, you found some kind of waste, that's distressed real estate. Mm-hmm. What is actually distressed when you talk about real estate is not the real estate itself. It's the way the real estate is financed. It's the capital stack that is distressed. The investors that, for example, the borrower on a loan is unable to service the debt that they put on the property. So I make that simple. They took out a mortgage to buy a multifamily deal, let's call it a $10 million building, and they borrowed $7 million in the hopes that the rent they were going to gather would cover the cost of servicing the debt, paying the mortgage, paying insurance and taxes. They were hoping that there would be enough rent, and that suddenly, for whatever reason, there is no longer enough rent to cover the debt service that they have to make. That is a distressed real estate deal. You see, it's not the real estate that's distressed. It's actually just the way the real estate was financed. Now, what's happened recently, through no fault, I would say, of most people, well, through no fault of real estate sponsors or investors, interest rates have gone up. And so what that has done is, even if your rents were stable, even if your rents were going up slightly, what's happened is that debt service, the cost of paying your mortgage, has gone up way faster than your ability to raise rents to cover those costs. Not only that, there's been a perfect storm. Insurance rates have gone up. So now you've got, not just you have higher interest rate costs, but you've got higher insurance costs. Cost of managing the building, doing upgrades, improving some of the units, all of that has gone up. So now suddenly all these business plans that were put in place 2, 3, 4 years ago, they're all no longer valid, right? They're busted business plans. So those deals are distressed deals. And those are the deals, being a little Machiavellian about it, those are the deals that will present opportunities to investors who have patience today. And I'm going to actually preempt your very last question. It's a teaser for your last question. What bulletproof advice? I'll come back to that later. Anyway, but that's distressed real estate.
Yeah, I mean, that's a great answer. I mean, there's one thing that I've noticed too, additionally to the financing, is that there is a way somehow to lock in financing for a longer period of time. So that way you have better predictability, so to speak, the air quotes predictability. It's not really predictability. When you know how much your debt service is, and you can pretty much, you'll know what that fixed rate is, at least for 5 years or whatever you negotiate with the lender. There's those guys that got into deals early on and got really sloppy with operations. And I'm talking just from a strictly operational perspective, where they let their expenses run rampant and they're still able to cover the debt service at a 3% rate. But then, yes, to your point, all of a sudden now it's at 7 and it's not performing anymore. Well, quote, not performing. And to your point, absolutely, it's not distress. It's that they got sloppy. And operations is probably the cause, more than likely, and I would imagine in many cases in the deals that you saw, operations is probably one of the biggest things. Would that be wrong?
Agostina, you hit the nail on the head. So we at Gower Crowd, as you know, we build crowdfunding platforms for sponsors. Typically, our clients are multi-cycle, seasoned, fairly large-scale sponsors. Minimum assets under management. We have one exception at the moment, but typically 100 million and up, right? We help smaller sponsors as well, but that's typical. So the people that we speak to are really sophisticated. They've been through cycles. They know what can go wrong. They've seen things going wrong. They've managed problems in the past. And so they come to investing today with a very, very different perspective, or seeing it through a very different lens from somebody who thinks this time is different, prices, things are never going to change, everything's going to be great. And one of the number one things that seasoned professional sponsors talk about being the biggest problem with novice sponsors is not having intense hands-on management of the properties that they own, that they are not there on site, that they're not managing it. I was talking to Sean Burton at CityView, who's one of those institutional investors who you see, all that money on the sidelines. He's one of those guys. And he said that one of the biggest lifts that they get often when they buy a value add property is management. Just the management, taking over management from somebody who delegated it to a sloppy that's not his words, by the way, these are now my words, but to a sloppy third-party management company who's not really motivated by the profit motive. They're motivated to keep their time down to a minimum, do the bare minimum to get their fee. Who cares? They get paid a fee for as a percentage of how much work they have to do. So what's the incentive to keep costs down? So professional shops will take management in-house, they will manage it themselves, and they will be very tight on that management. You are exactly right. It is a management and operations issue first. There are other things, but that's one of the most important.
Yeah, exactly. Because typically a lender would, at the onset anyway, they would typically not do a deal if the deal's a terrible deal, right? Of course, they don't have crystal balls either. But I think that if they're counting on your ability to operate the asset appropriately and running it properly, that's the biggest thing. I would venture to guess, we haven't bought distressed deals yet. We usually buy value add type scenarios. We do developments too. We do that kind of stuff too. But yes, I see, whenever I see a distressed asset, I see operational issues all day long. That's what it is.
Are you seeing it? And I'm going to turn it back to you a little bit.
Yeah.
Now. Are you seeing distressed deals out there, Agostino? You talk about seeing them.
I've only seen a couple, and those are the ones that are, how should I say? I wouldn't say they're actively marketed; they're quietly marketed. But I've already gotten word. I get the word on the street on certain individuals, certain buyers, big buyers that are having issues. So yeah, it's happening. It started happening, I'd say, like maybe 8 months ago, where the exact scenario you just described was happening. And like you said, it's not always the sponsor's fault. Sometimes it's the city. The city decides to implement some stupid new rule that now works to the tenant's favor, and the tenant will just take advantage of it. Like, for instance, you can't evict anybody now. Wow. Okay. So now as an operator, you have all these people that aren't paying. What do you do next? Right.
Exactly right. Yeah.
It's a big problem.
It's very challenging. Well, that was a pandemic induced situation, right? With no evictions and, rent postponements, etc. Of course, that's mostly flushed out of the system, not entirely.
Yeah.
Depends where you are. Where are you?
Yeah, it depends where you are. We're in Cleveland, Ohio. Yeah, we're in Cleveland. But I think part of it too is also trying to recoup all those losses. So when you have a large asset, 500 units, or a large collection of assets, and a whole bunch of people, like 100 people, decide not to pay for 12 months.
Oh, yeah, you're in, right, exactly.
That's a problem right there. Yeah, yes. You're in. It's like, so great, you finally get rid of those people. Now you've taken on the cost of the eviction and taken on like all this debt, and you're never going to see that money again. That's where it sucks. That's where it's not good. So anyway, how does someone find and invest in these types of deals then? Because you create the platform then for like sponsors like me, for instance, that say want to go out and buy distressed assets. Is that what you're doing? If you're loving the show, let's connect. Find me on Facebook, Insta, YouTube, and all the cool social media platforms. I love hearing your feedback, and it helps us keep delivering top-notch content to amazing investors like you. Thanks so much for being awesome, and let's jump back into the action.
So what we do is we build platforms for people like you so that you become a capital raising machine. So you want to be able to attract investors, passive investors, and then help them come to know you so that they trust you enough to invest with you. So those are the platforms that we build. We build those kinds of crowdfunding platforms for sponsors. We don't necessarily help you find deals. That's up to you. However, I will tell you there are a few ways to find opportunities as a sponsor. So let's talk about both audiences. both sponsors like you who are raising capital and also passive investors who want to invest. So sponsors, there are a few ways to do it. It is not easy to get into the deal flow, but brokers are a good source. Obviously, they've got their ears to the ground. They also know who they sold to recently who might be having trouble. They'll know who's got leases coming out, or they'll be if they're good brokers, they'll be close to their client base and they'll know who's struggling. So you want to be in touch with brokers. Another is receivers, right? So talk to receivers, people who banks go to take over properties, because their job, a receiver's job, is to manage distressed deals and eventually to get rid of them. Another good source, let's use 3 sources. Another one is bankers. Oh my goodness. Special asset managers, right? This is a euphemism for distressed real estate or distressed debt, special assets. So try and find out who are the special assets managers at banks in your area. And they're tough to deal with, but you might find some who are really user-friendly. They'll typically only work with existing customers. So maybe start with whoever your bank is and see if they don't have anything that they can talk about or make introductions for you. Now, on the passive investor side, inevitably, investors are going to be getting notices that distributions have stopped. They might be getting capital calls from existing sponsors. So you've got to figure out whether or not it's a good idea to up your investment in those deals if you've got a sponsor who wants to raise some more money. And that's something here at Gower Crowd that we're working on. It's very complicated. It's the first time that it's happened since general solicitation, since the Jobs Act. So there's a lot of people who this is their first rodeo. I mean, it really is, right? Yeah. Getting bucked off the bull or whatever, getting thrown off the horse. This is, to continue the rodeo metaphor, this is the first time. So understanding how to navigate that, we're working on some programs to help both passive and active investors, professional investors, deal with that. But once you've got past the terminated distributions and capital calls, and you're starting to look for new opportunities, and there will be new opportunities, discounted deals, this is what passive investors should look for. They should align themselves with sponsors who are, number one, communicative. Oh my goodness, sponsors who are communicating intelligent, high-value information about what's going on and how they're dealing with the market. Even if it's a sponsor who is struggling, if they've gone quiet, you leave them alone. But if they are communicative and they are open and transparent about what's going on, and they're looking for deals, they might be bringing deals to you. And on the one hand, while you may lose on one deal, you may have one step backwards, right? Because a deal started to struggle. Look for 2 steps forwards in terms of buying distressed deals. So again, that's something that we're doing. And Agostino, we should definitely stay in touch, because we have a large network of accredited investors, and we're always looking for opportunities from our developer network as they find deals. But what I will also tell you is it is a slow motion train wreck at the moment. Stuff is not happening quickly. It's not like the global financial crisis where everything went off a cliff kind of overnight and then suddenly the market was awash. Go on, you were going to say.
No, I was just going to say, it happened very, very quickly. That happened very quickly. I was there for that, and it was nuts. It's kind of like everything was chugging along, then all of a sudden, I think at first, I think there was leading up to that leading a week up to the actual crash, you saw some things happening in the market which were kind of odd, and before you can figure it out, it was already too late.
Exactly,
that was
right.
Wild. Yeah. But I completely.
This market is different. This one is a managed decline. It's slow, but inevitable. So, so I'm not going to get to your bulletproof advice yet, because I will get to that later. Let's be patient and wait for that. He said,
yes.
Dropping hints about what to do today.
Well, but I'll tell you what then. So let's say, for instance, there is someone listening right now that is just like me, saying that there's another sponsor and they're interested in the platform. underwriting a quote distressed deal, right? Aside from the operational and the capital stack issues, right? Underwriting it is basically the same sort of scenario, right? I mean, certainly it's, to me, I've done enough deals now that I know how to underwrite those sorts of things. Are there any special underwriting tools or special underwriting guidance that's really necessary to underwrite a distressed deal so you know what the hell you're buying? Because that's probably one of the biggest things. Doing a value add deal is one thing. Maybe you're at 80% and, you wanted to get it to 90, that's fine. I mean, it's usually, it's not that big of a lift. You typically know what you're doing. And if there's enough cash flow, you can probably find a hard money lender to get you in there and bring it up those last 10% and you should be fine. If it's distressed, you're probably sitting at about 50% and things are really, really
maybe and maybe not. So there are a few other things with distress that you've got to be really careful about. Buying distress. Deals are distressed for reasons. So as soon as this is what you're going to see. In most cases, or in many cases, what will happen as a sponsor starts to struggle on a deal is they will start to cut corners. So they'll stop doing deferred maintenance, or they'll stop maintaining a property. They may not pay contractors. So there are all kinds of things that you wouldn't normally see in a healthy market that may remain hidden under the surface of a distressed deal. Because everybody, especially if it goes back to a bank, because a bank is going to sell it to you as is, where is, no reps or warranties of any sort, right? Completely without liability. So you are going in blind. There is no recourse for you if you discover something after the sale, whether they sell you a note or an REO. If you're buying a distressed deal that is marketed from a sponsor, that sponsor is going to be, and their agent, brokers, are likely to be painting the best possible pictures being marketed. So you got to present that. So there are three things that you got to keep an eye out for. There are plenty more, but I'm just going to summarize three of them. One, watch for litigation that may be bubbling under the surface. Two, deferred maintenance, stuff that has been papered over, that would normally or should normally have been dealt with with a higher budget if the projects have been performing properly, that has been patched together that you might not see. You've got to be really on the ground. You got to either know that it's there or look for it and identify where it is so you can underwrite to it, or assume that there are going to be those kinds of extra costs in your underwriting so you don't overpay. That's kind of called the falling sword. That's part of the falling sword scenario as well. Yeah. Even if you think you're getting a bargain, you might not be, right? Especially if the market's still coming down. And the third thing is those unpaid expenses that might come with liens. If the property has had maintenance or upgrades done on them and the subcontractors haven't been paid, they're going to be ahead of you as the buyer. You've got the first position loan, and then you've got liens in there as well. So there are all kinds of things to look for in distressed deals that you should look for anyway when you're buying something during a healthy market, but are more prevalent during a down cycle and harder to locate and find, and more important to locate and find even during a down cycle, because they're likely to be bigger problems. So it's not quite the same as underwriting during the good times.
Yeah, I think due diligence takes a huge precedent. Of course, I'm not saying people are ever lazy. I don't know how other people underwrite their deals, right? But when I mean underwriting, I don't just mean the financial part, which is important, but also it sounds to me like the physical underwriting too is just as important, right? That deferred maintenance, understand what is the true nature of the deal itself from a physical perspective, because certainly the liens are easy to look up and you can see where the rents are, and you can see what they should have been, and you can see any type of outstanding balances and whatnot. You can usually account for that. If there's anything that's not shown, clearly that's a whole other thing. That's fraud now. That's a whole different scenario. But the physical asset becomes a very big deal in terms of underwriting. looking at every single unit, scoping out all the sewage lines, making sure that the deferred maintenance has been taken care of or not taken care of. Know what it is you're getting at. There's people I heard of, Adam, that they would literally paint the roof so it looked like it was a brand new roof. It was painted. It wasn't even. It was the roof was a disaster. But they just painted it over to make it look nice. That way when the drone flew over, it looked like it was brand new.
So this gets back to the original point that you brought up about management. Not only do you have to have hands-on management, but when it comes to, especially, well, at any time, but particularly during times of distress, you've got to be really, really hands-on with your due diligence. Otherwise, you can make terrible mistakes. But you can, if you are good at what you're doing and you are thorough, the opportunities to buy at significant discounts are real.
Yes, absolutely, absolutely. So let's talk a little bit about how a sponsor engages with the platform. So currently I have a different platform. That's how we take on our investors today. If I go onto your platform, is this like an exclusive type scenario? Does it talk to the existing platform? Is there like a bridge between these two? Like, how does that part work?
So let me stop you right there. We don't have a platform per se. We are a marketing agency, digital marketing agency. Can't believe I say that. Even when I do say it, I can't believe I say it, because really I'm a real estate guy. But my business today is digital marketing. So we build platforms for you. I have a website with massive amounts of information. There's a million a million words of content on the website, dozens of training videos, a lot of them free, some of them for small fees. But we are a resource. The website, gowercrowd.com, is a resource, not a platform. It is educational, and that's all it is. We build crowdfunding platforms for our clients. So we don't raise money, although we might do during this cycle. Once guys like you come to us with deals, we may well push those out to our investors. But that's not our business up until now. We build platforms for sponsors so you can raise money. We don't raise money for our clients. We let them raise it, but we give you the tools to make your capital raising that much more effective and efficient so you can raise more faster from more investors.
Good. So how would I actually engage then? Like, how would I use your platform then to help me find a deal? Like, do I have to find a deal first and give you a call? Like, how would I do this?
Yes. So you've got to have your own deals, and then you would hire us. There's two ways to hire us. We can either build a crowdfunding platform for you, right? So we'll build it for you. It takes 6 months. There's a lot of work, a lot of tech goes into it, but we do soup to nuts. We do absolutely everything for you. So at the end of that, you've got a platform that functions in the same way as CrowdStreet. It's out there, people see it, they come to your website and they think, oh my goodness, look, I want to invest with this guy. Look at all this stuff I can learn from him. I totally trust him. I want to invest with this guy, with you. We build that platform for you. So that's one way of working with us. We charge you a fee for doing that, right? Monthly fee for 6 months. And we build a platform for you, crowdfunding platform. Or we can show you how to do it. I personally guide people. It's a 12-week program. I will show you how to build a state-of-the-art crowdfunding platform so you can raise capital. If you want to find deals, that's a whole different thing. You can use some of the marketing tactics and techniques that we can show you to find investors. You can also use those to find deals. I'll give you an example. We have a medical office building client, and he wanted us to help him find medical office buildings that weren't necessarily for sale. So we created a marketing campaign to go out to physicians across the country to say, look, here's the reasons why you might want to sell your building. And guess what? Good news is we'll buy it. Not me, my clients, right? So we built this system for my client so they could go out and find deals. That's unusual for us to do that. But he hired us to help him find accredited investors to invest in his fund. But he said, I also want to find deals. So let's come up with a marketing campaign to help you do that. We also, for our private clients, Agostina, we do all kinds of stuff. We do recruitment, we do paid advertising, we do just about everything that you could imagine needing to raise money and operate a business. We do it all for you, or we show you how to do it.
Nice. I would have to imagine, though, if someone has any inclination to do this, they probably need to start it like, if they want to get into this business, they got to start it like today or fairly soon, just because if it's taking you 6 months to build this thing out, clearly it's not like, hey, I just found a distressed asset. Here it is, just fell in my lap. It's going to take more than 6 months to close that deal, right?
Yes. So, well, it's going to take, no, if you don't act super quickly on distress, you're not going to get the deal.
Right.
So I was invited to some kind of conference where the theme was how to raise $5 million in 10 days, right? How do you do that? Well, it's a simple answer. And the simple answer is, if you want to raise $5 million in 10 days, start 12 months ago. That's how you do it. You can't expect to start today. You got to start and you build a foundation. Again, this is what we do for our clients. We will build that foundation for you. But once you've got the foundation, then you plug your deal into it and investors will come to you and they will invest with you and they'll finance your deals in 10 days if you've got the right deals and the right background, etc. But you've got to have the right foundation, and that's what we build for you, or we show you how to build for yourself.
Yeah, I mean, that part is huge right there. I mean, it doesn't matter what you're investing for, by the way. It could be for development or distress or any type of deal. People just think that you just turn on the spigot, people just start throwing money at you. It doesn't work that way. I love that analogy. It's like, if you want to raise $5 million in 10 days, start 12 months ago at a minimum. But part of it is starting 12 months ago, and also keeping up with communication, letting them know what's going on, the deals you're looking at, maybe the state of the market, all kinds of other things. I don't want to turn this into a capital raising discussion here, but it's a critical component to being able to raise money. If someone really does want to do distressed assets, you have to start today to really start describe what your overall business plan is of what you're going to do. That part is huge. So yeah, absolutely. So now, what sort of projections do you have for the next say 12 to 18 months in terms of distressed commercial real estate? Having trouble finding deals? The brokers are the key to your next deal. Check out my guide that has helped me meet dozens of them. Go to guidetobrokers.com and download the guide today.
All right. So I'm going to start with a much shorter time frame prediction. Now, I've actually got a hard stop at the top of the hour. so I've got a 9-minute prediction for you right there. But over the next 6 to 18 months. So this is people talk about a soft landing. This is a slow, a managed decline. And it is a slow motion managed decline. So we are still going to hit a hard bottom, but we're going to reach it slowly. That is by design. The Fed Chairman Powell is sticking to 2% inflation, not for any other reason, but to set expectations so that people understand, where is the end of this road? If there was no target, we wouldn't know. We wouldn't know what the objective was. So whether it's arbitrary, whether it should be 3% or 0%, Powell is setting that so that there are expectations and we can all know where the end of the road is, right? So it's predictable. Secondly, you've also got regulators encouraging banks to extend loans for borrowers. That is, they're not pretending anything. Extend and pretend is a mischaracterization. This is extend in order to slow down the decline in the commercial real estate industry. If in values, if there was a mark to market, it's a bit technical, but if a regulator said you got a mark to market, we fall off a cliff. All debt would be non-performing. Values would be seen to be significantly less than they are today, or than they are seen to be today. You would have a precipitous decline. So we are looking at a slow decline. Over the next 6 to 18 months is when you're going to see most of the opportunities. Plenty of time to prepare yourself. And why don't we tee up the bulletproof advice, because that is actually what you should be doing right now. Go on, ask me that question.
Yes. I know.
Pop the question.
Pop the question. Here we go. Will you give me your bulletproof advice?
And therefore, what you should be doing today and have in your mind is patience. Be patient. Don't rush into anything today. Keep your ear to the ground. Look at opportunities all the time so that you recognize a really good one when it's in front of you, and don't jump at the first shiny object. Be patient. There is going to be more decline. Prices are going to come down across every single asset class in the next 6 to 18 months. Align yourself with a sponsor who you trust, who can demonstrate they know what they're doing in distress, and be patient. Be ready to act when the time comes, but don't rush into it. That's my bulletproof advice for today, August 2023. It's going to be different in 12 months.
Right. Well, I love that advice. I keep saying the same thing in my mastermind to my students. So it's great. It's great advice. All right, guys. Well, if you want to reach out to Adam, you can reach him via his website at gowercrowd.com. Hope you got some insight on how to get into distressed deals. All right. If you really are interested in doing this, of course, reach out to Adam. But secondarily, start learning how that deal works, how to put those deals together, start reaching out to finding who could lend on those deals, the whole 9 yards. It's a different type of asset class, but it can be learned like anything else can. All right, guys. So thanks for tuning in. I'll see you next episode. Take care.
You've been listening to the Bulletproof Cash Flow Show. We hope you've enjoyed the show. We know we had fun. Make sure to visit our Apple Podcast page and leave us a 5-star review. We hope you've gotten some useful and practical information from the show. For real estate coaching, events, and resources, hit up bulletproofcashflow.com. Till next time.
No information in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this show are limited to accredited or sophisticated investors. Any investments will only be made with proper disclosure and subscription documentation and subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice.